Hi, everyone. I'm Mike Prado, Portfolio Manager with Hillside Wealth, IA Private Wealth. And for the last 20 plus years, we've been structuring retirement plans and financial plans for incorporated business owners and professionals. And never have we seen so much change as we have in the last 7 years. So really, it's time now for us to make changes to the old playbook that used to be intact and to really adapt to these new rules and make sure that retirement plans for business owners and incorporated professionals are sound, structurally sound, and able to deal with today's new tax environment. So the three big things that have happened in the last 7 years, which have kind of changed the landscape, are first off, TOSI. So tax on split income has made it so that an incorporated professional or business owner can't split income as efficiently as they used to be able to while working. So that was the first rule. And then the second thing that came into force was that passive income, or let's think of that as income other than what a business owner derives from their active business. So this could include rental income from an investment property. This could include income from generated from an investment portfolio. Anything that's not related to the active business. That passive income is taxed at a much higher rate, first off, and second off, it starts to grind down the small business deduction that this business owner relies on. And then the third thing was Budget 2024 was the increased capital gains inclusion rate. So when we look at these three rules that have come into play, it's really made a meaningful impact. And we've seen it. There used to be a big advantage for business owners to actually pay out only what they needed to live, pay their mortgage, buy groceries, go on trips, whatever they needed to do to live the life that they wanted, and then to actually keep everything inside the company and save it, and for a rainy day or for retirement. That is no longer the case. In fact, we've seen the advantage, let's say, of saving inside the corporation come down meaningfully. And in certain situations, it actually makes less sense to save inside your corporation now than it would pull it out and invest outside of your corporation. So all of this is to say that it's time to start thinking about alternatives to the old playbook. And the old playbook, as described, was, split the income as much as possible while you're working, take only what you need, and invest everything else inside the corp. So the first thing that you can do to fight this off is by looking at RRSPs and actually maximizing whatever you can if you have unused RRSP contribution room. And we've seen cases where there's hundreds of thousands of dollars of unused contribution room that we were able to put to work and help create a more tax efficient retirement plan. The second rule of thumb to remember is to start looking at IPPs. So IPPs are a great tool, been around forever for incorporated professionals or business owners over the age of 40, earning relatively high T4 income amounts. If that's you, IPPs are likely a very, very good option for you. And then finally, the balance, whatever's left that you can't save in an IPP and RRSP, should be saved inside your corporation still. You shouldn't be taking it out now and paying tax in all likelihood and saving it personally. But again, each situation is different, and we want to make sure that your situation, the circumstances, and the details of your situation are taken into account before we give full-scale advice on that. But those three steps should be followed before simply just blindly saving money inside the corp. A very, very quick example of this is we just met with a business owner last week. This business owner wanted a second opinion on their portfolio, which we provided, and their portfolio was fine. It was fine. And this portfolio was about $1.2 million. And this was for a 60-year-old business owner. But what this business owner didn't have at all was a retirement plan. They had no concept that this $1.2 million portfolio was going to be able to generate roughly $30,000 a year of after-tax lifestyle from age 65 onwards. And this was a bit of a shock to them. So important to think beyond just the portfolio and to think about the entire retirement picture and plan. And that is the biggest thing that people need to pay attention to when they're going into retirement is, do they, what is their plan? Do they have enough saved to be able to have the life that they want in retirement? So for more information on the IPP and how that works, please have a look at this video here where we go into great detail about how the IPP is structured and how you can take advantage of it. Thank you so much. It's been a pleasure. Have a great rest of your day.